Greetings from MWN.com. Dr. M. Wilson, formerly Vice Principal and Head of Department of Commerce, Scott Christian College, Nagercoil, is delighted in presenting this session. Thank you. Please subscribe the channel MWN.com. 1. Simple interest. SI equals PNI, P principal amount, N, number of years, I, rate of interest per annum. A equals P plus SI, amount together with simple interest. Illustration 1. Calculate the interest for 5 years at 6% simple interest for an investment of 20,000 rupees. Solution. SI equals PNI, P equals 20,000 rupees, N equals 5 years, I equals 6% equals 6 100ths equals 0.06. SI equals 20,000 x 5 by 0.06 equals 60,000 rupees. Illustration 2. X invested 5,000 rupees in a bank at 10% simple interest. How much he will get at the end of 4th year? Solution. A equals P plus SI, SI equals PNI, P equals 5,000 rupees, N equals 4 years, I equals 10%. SI equals 5,000 x 4 by 0.10 equals 2,000 rupees. A equals 5,000 plus 2,000 equals 7,000 rupees. 2. Compound interest. In compound interest, the interest also earns interest. Interest for the second year is calculated for the principal and the interest earned for the previous year. CVN equals PO into 1 plus I raised to N. CV equals compound value, i.e., principal plus compound interest, PO principal amount, N, number of years, I, rate of interest per annum. C equals CV, PC, compound interest. Illustration 3. If X invested 50,000 rupees for a compound interest for 5 years at 9%, find out the amount he will get at the end of 5th year. Also calculate the compound interest. Solution. CVN equals PO into 1 plus I raised to N equals CVN equals 50,000, 1 plus 0.095 equals 50,000 by 1.095 equals 76,931 rupees. C equals CV, P equals 76,931 50,000 equals 26,931 rupees. Calculation of compound interest for variable periods. Compound interest may be given on the basis of monthly or quarterly or half-yearly or annually. It means interest compounded monthly or quarterly or half-yearly or annually. Previous illustration is an example for interest compounded annually. The formula for the interest compounded in various periods is given below. CVN equals PO. CV equals compound value, i.e., principal plus compound interest. PO principal amount, I, rate of interest per annum, N, number of years, M, number of times in a year compounding is done. C equals CV, PC, compound interest. Illustration 4. X invested 30,000 rupees for a compound interest for 5 years at 10%. The interest compounded half-yearly basis. Calculate the amount at the end of 5th year. Also calculate the compound interest. Solution. PO equals 30,000 rupees, I equals 10% equals 10 100ths equals 0.1, N equals 5, M equals 2. CVN equals 30,000 by 1.629 equals 48,870. C equals CV, P equals 48,870 30,000 equals Rs. 18,870. Illustration 5. Y invested 60,000 rupees for compound interest for 6 years at 12%. Calculate the amount at the end of 6th year, if interest compounded 1 annually, 2 half-yearly, 3 quarterly, 4 monthly. Also calculate the compound interest. Solution. PO equals 60,000 rupees, I equals 10% equals 12 100ths equals 0.12, N equals 6. Solution. 1. Interest compounded annually. CVN equals PO, 1 plus I, N equals CVN equals 60,000, 1 plus 0.12, 6 equals 60,000 by 1.12, 6 equals 60,000 by 1.974 equals 1 rupee, 18,440. C equals CV, P equals 1, 18,440 60,000 equals 58,440 rupees. 1.12 raised to 6 can be known from the calculator directly or multiply it for 3 times and then multiply the result with 1 time. 2. Interest compounded half-yearly. Half-yearly interest means 6 into 2 is 12 times interest is calculated. CVN equals 60,000 x equals 60,000 by 2.0122 equals 1 rupee, 20,732. C equals CV, P equals 1, 20,732 60,000 equals Rs. 60,732. 3. Interest compounded quarterly. Quarterly interest means 6 into 4 is 24 times interest is calculated. CVN equals 60,000 by 2.0328 equals 1 rupee, 21,968. C equals CV, P equals 1, 21,968 60,000 equals Rs. 61,968. IV, interest compounded monthly. Monthly interest means 6 into 12 is 72 times interest is calculated. CVN equals 1 rupee, 22,820. C equals CV, P equals 1, 22,820 60,000 equals Rs. 62,820. Compound value of different cash flows, annuity. Compound value cash flow is concerned with annuity. It is related to cash outflow and cash outflow. 1. Compound value of deferred annuity. It is related to the amount to be received at the end of specific period for annual investment of certain money, same amount, every year for certain rate of interest. This may be the investment at the end of the year or investment in the beginning of the year. A compound value of amount for investment in the beginning of the year. The formula is mentioned here. CV equals compound value. That is, principal plus compound interest. PO is principal amount, N is number of years, I is rate of interest per annum. Illustration 6. X invested in the beginning of every year an amount of 10,000 rupees for a compound interest for 5 years at 12%. Calculate the amount at the end of 5th year. Also calculate the compound interest. Solution. PO equals 10,000 rupees, I equals 12% equals 12 100ths equals 0.12, N equals 5. CVN equals 10,000 by 6.35 by 1.12 equals 71,120 rupees. It may be calculated on the following basis also. 5-column table should be prepared. In second column amount paid, that is, 10,000 rupees for all 5 years should be written. In the third column number of times compounded is written. For example, in second year, only 4 years is left. In the fourth column, compounding factor should be written. Then the amount after calculation should be written in the last column. Hence it is known that the interest is 71,130 minus 50,000 equals 21,130. A compound value of amount for investment at the end of the year. The formula is CVN stated here. CV equals compound value. That is, principal plus compound interest. PO principal amount. N, number of years. I, rate of interest per annum. Illustration 7. Y invested at the end of every year an amount of 20,000 rupees for a compound interest for 7 years at 10%. Calculate the amount at the end of 5th year. Also calculate the compound interest. Solution. PO equals 20,000 rupees, I equals 10% equals 12 100ths equals 0.1, N equals 7. CVN equals 1 rupee, 89,740. It may be calculated on the following basis also. 5-column table should be prepared. In second column amount paid, that is, 20,000 rupees for all 7 years should be written. In the third column number of times compounded is written. For example, in first year, only 6 years is left since investment is done at the end of the year and hence no interest for the first year. Like that in the 7th year no interest is given since investment is done at the end of the year. In the fourth column, compounding factor should be written. Then the amount after calculation should be written in the last column. Hence it is known that the interest is 1,89,740 minus 1,40,000 equals 89,740. C. Compound value for different amount of investment at the end of the year. Investment of different amount for some years can be calculated separately and sum of all of it should be calculated to find out the total amount of the investments. It can be calculated as follows. CV equals compound value, i.e., principal plus compound interest, PN principal amount, N, number of years. I, rate of interest per annum. Illustration 8, a deposited 20,000 rupees, 25,000 rupees, 35,000 rupees, 50,000 rupees and 60,000 rupees respectively for the end of first, second, third, fourth and fifth years. The interest is at 9% on the basis of compound interest. Calculate the amount at the end of fifth year. Also calculate the compound interest. Solution. I equals 9% equals 9/100ths equals 0.09, n equals 5. CVN equals 28,230 plus 32,725 plus 41,584 plus 54,500 plus 60,000 equals 2 rupees, 17,039. See compound value for different amount of investment in the beginning of the year. Investment of different amount for some years can be calculated separately and sum of all of it should be calculated to find out the total amount of the investments. It can be calculated as follows. CV equals compound value, i.e., principal plus compound interest, Pn principal amount, n, number of years, I, rate of interest per annum. Illustration 9, K deposited 30,000 rupees, 20,000 rupees, 45,000 rupees, 60,000 rupees and 75,000 rupees respectively in the beginning of first, second, third, fourth and fifth years. The interest is at 11% on the basis of compound interest. Calculate the amount at the end of fifth year. Also calculate the compound interest. Solution. I equals 11% equals 11/100ths equals 0.11, n equals 5. CVN equals 50,550 plus 30,362 plus 61,542 plus 73,926 plus 77,700 equals 2 rupees, 94,080. Total deposit equals 30,000 plus 20,000 plus 45,000 plus 60,000 plus 70,000 equals 2 rupees, 25,000. Interest equals 2, 94,082, 25,000 equals 69,080 rupees. Calculation of present value. Present value is concerned with the amount to be received in future. It is just opposite to compound value. In compound value, the amount to be received at the end of some specific years with certain rate of compound interest. But in present value, the present value of the amount to be received in future at some specific rate of interest. It may be for a single amount or for the continuous cash inflow or outflow for a specific periods for same amount or for different amount. 1. Present value of a single amount. It can be calculated through the formula as mentioned here. PV, present value, I, rate of interest, N, number of years, FVN, future value after N number of years. 1 by 1 plus I raised to N is present value of annuity factor which can be known from the PV of annuity table. Illustration 10. Calculate the present value of 75,000 rupees to be received at the end of fifth year with a compound interest at 12%. Or it may be asked as, how much X has to invest now to receive 75,000 rupees to be received at the end of fifth year with a compound interest at 12%. Solution. I 12% equals 12/100ths equals 0.12, N equals 5, FVN equals 75,000 rupees. PV equals 7 by 0.56788 equals Rs. 42,591. 2. Present value of series of cash flows. Series of cash flow means inflow or outflow of cash for different periods. The cash flow may be fixed or same amount or different amounts. Inflow of cash is due to the profit or returns from investment for specific periods of time. Outflow means deposits into bank or investments in projects.